Hi friends and welcome to another video of Just Being Earnest. In today's video, let's look at whether are T-bills and Singapore savings bonds, is it still worth investing today? With interest rate on the move and yields dropping, many investors are asking a critical question, which is, are Singapore T-bills and Singapore savings bonds, are they still the best place for your cash? With an evolving rate environment, and what worked last year may not work today. So if you're looking for a better way to earn on your savings, then you should watch this video. Let's look at the numbers. The reality is that the use for these safe haven assets has been falling. The latest 6-month Singapore T-bills cut-off use has recently slipped to 1.41%, dropping from 1.44% in the previous auction. And the current 10-year Singapore savings bonds, which offers an average return of about 1.83%. Even US Treasury bills, which remain safe, are offering down low yields amid Federal Reserve policy shift and global economic uncertainty. These are still minimum risk investments, but their returns are becoming rate sensitive in this environment. So why are we seeing this drop in the yields? The trend is driven by two major global factors. Easing inflation concerns. Global interest rates have been trending down since mid-2024 as central banks respond to cooling inflation pressures. As inflation moves closer to targets, the need for high interest rate decreases and this pushes bond yields lower. Another thing is because people are moving to safety, so even geopolitical tensions can contribute to falling yields. When global uncertainty rises, it drives increased demand for government bonds, which are seen as safe haven, pushing their prices up and their yields lower across the markets. Which of these government-backed options is better for you right now? It comes down to your priorities. For Singapore savings bonds, they are long-term investments up to 10 years with a step-up interest rate where the returns increases over time. And they offer monthly redemption, which is flexibility without penalty, making them highly liquid. And the 10-year average return is currently at 1.83%, and Singapore savings bonds generally offer better returns and flexibility than T-bills or fixed deposit. On the other hand, for Treasury bills or T-bills, these are short-term investments and are typically 6 months to 1 year and are highly liquid. The current 6-month yield is lower at 1.41%. While they offer minimal risk, they are more susceptible to falling rates over their short duration. So should you still invest in Singapore T-bills or Singapore savings bonds? And here are the pros and cons. For the pros, both are extremely safe, offering government-backed capital preservations. SSB in particular still offer better returns than fixed deposit, and their flexibility suit conservative investors or retirees. For the con side, this is due to the declining returns. The primary risk is the opportunity cost. Yields are declining and your real returns may be negative after inflation, and there's also a risk of missing out if other assets starts to outperform. T-bills with the shorter duration offer lower yields overall. If you're looking for higher returns, here are a few alternatives to consider. There is the high interest fixed deposit. This offers rates around 1.35% to 1.6%, but are less flexible than SSB. There's also corporate bonds and bond funds. These can offer higher yields, but you take on increased credit risks. Another alternative is dividend stocks and REITs. These offer potential for income and capital growth, but you must be ready to accept market volatility risks. And another one is money market funds. This may offer higher yields, but you need to watch for regulatory and counterparty risks. A balanced approach is often best, which is to diversify across safe bonds, equities, and cash alternatives. So conclusion, what should you do now? Your decision ultimately depends on your financial goals, risk appetite, and investment horizon. If capital preservation is a priority, if liquidity and safety are top concerns, then SSB and short-term T-bills remain solid choices despite the lower yields. But if you're seeking for higher income and you can tolerate some risk, consider mixing in corporate bonds or dividend stocks for better returns. And you might want to stay informed and regularly monitor inflation and interest rate trends, as rising inflation can significantly erode fixed income returns. T-bills and SSB are still secure options for your cash, but they now only offer modest yields amid falling rates. Be flexible and align your cash investment with your personal priorities for long-term success. So what are you doing with your cash now? Let me know in the comments below, and don't forget to like and subscribe for more financial insights. As always, do remember to make smarter financial decisions every day. Have a great day ahead, and bye bye.